Thank you for coming. We love our subscribers, and we really exist to help you folks. And, I have a fancy formal presentation here, but knowing me, I'll mutate and talk about some other things. But we do want to start in this session talking about the earnings recession. And I just want to generically explain what this is all about before I get in the formal presentation. A little bit about my background. I'm originally from Berkeley, California, so I'm fully trained in socialism. I was taught that we're all supposed to earn the same amount of money, because if one of us out-earns another, it creates social unrest. And the Berkeley view of the world is everybody better index, because that's the only way we're ever going to have social harmony. And so I'm pretty old. This is back in the early 70s. I'm in college, and I'm old enough I had a slide rule and things like that. But the government had passed a law called ERISA. And what ERISA means is, when the lawyers interpret it, if you can match a benchmark, you have no liability. So Wall Street, being Wall Street, would love to have money and have no liability. So he says, gee, let's start cloning these benchmarks. And indexing hadn't really taken off, so I was behind the scenes on one of the first projects. And our goal was to figure out how to mirror the S&P 500 without buying all 500 stocks, because again, index funds hadn't taken off. So what happened is I figured I needed 332 stocks to mirror the index. And how do I say this in a nice way? I was a failure. I accidentally beat the market. And again, the project was to mirror it, not to beat it. So I later learned I was lied to, and there were anomalies and inefficiencies in the market. So I set out to document that. And I originally started in small cap, and the MPT review was mostly a small cap letter. It's now emerging growth. And the reason we started in small cap, we just assumed it would be more inefficient. And then we've always been a pioneer in this quantitative analysis. And just so you know how cumbersome it was, back when I was in college, I had full access to Wells Fargo's computers, but these were punch cards, and we'd program the mainframe computers. And then I still remember I had a TI programmable calculator where every stock was a card going through the computer. And so literally we'd key in all this stuff manually, and then I'd get a Barron's on a Saturday, and I'd key in all the data because of the Friday's closing prices. And we started with monthly systems, and we went to weekly, and then Lotus used to sell us a few years later a disk drive with data on it, and it would call on a modem to get the latest data. And I still remember how exciting it was to get the first 2400 baud modem. And computers back then had no memory, so we'd have to link them and do these things called macros. Anyway, so we've always been building these databases from scratch, and for over 20 years we've been totally automated. And we use a service called FactSet. It's a public company, and we just crunch the data. Now I have a bunch of analysts, and then because I get the data every weekend, then I can go out and talk to you guys. So in the old days, I'd be locked up just building all this stuff. And so we really exist to find these anomalies and inefficiencies in the market. But while I've been doing this, indexing is continuing to prosper. It's continuing to mutate. Every ETF is an index, just so you know. And they tend to be rebalanced every 90 days. And the asset gatherers on Wall Street have been very, very good at convincing us that indexing is better than active. What they don't tell you is that, how do I say this in a nice way? They don't tell you that that a gross index can never be duplicated because it costs money to buy and sell it. Stanford, UCLA, and Arnhem University in Israel came out with a study last year that said it costs more to buy and sell ETFs than it does stocks. And it was very scandalous, because it says ETFs don't cost anything, they're free. No, they do. I have an ETF in Oppenheimer, and when I launched the ETF, I got to ring the bell on the stock exchange, and just so you know, the bell's a button. Okay, it's not a bell. We just hit a button and a sound comes out. And then ever since I launched that ETF, I've been fighting with my specialists. First it was Goldman Sachs, now it's Cantor Fitzgerald, because they're always, putting premiums or discounts when somebody wants to buy the ETF. So, you can never get the actual index returns because there's transaction costs, and that's the first problem. The second problem is all these asset gatherers on Wall Street, okay, which control, 85, 90% of the money. What they fail to tell you is they don't make a lot of money on fees. So they tell you, oh, we're good people, we don't make money on fees. But what they're failing to tell you, they control those specialists on the exchange. Okay? I could have a specialist on the New York Stock Exchange if I wanted to. And every time the market moves and people get nervous, they make money through their specialists. So what's happening is the people that are controlling Wall Street, it's a transaction system. It's not a management system. And this is starting to get exposed more and more. And so you're going to hear about the death of indexing in the upcoming years. One reason you're going to hear about the death of indexing is none of the indices did well last year. All of them poor. The 10 S&P sectors, S&P was totally dependent upon Netflix and Amazon last year, which have horrific fundamentals. They're getting hit hard this year. They've been downgraded. I'll talk a little bit about that. So, but the other thing is the S&P is a cap-weighted index. And 48% of the S&P sales come from outside of America. So if my name is Caterpillar, it's just horrible for me because I'm getting paid in all these depreciating currencies. And it hurts my sales growth, it hurts my bottom line. The stronger dollar has pinched their profits. So the S&P is about to have its fifth quarter in a row of negative sales, and according to FactSet, its fourth quarter in a row of negative earnings. So it's very hard for the S&P to keep going higher when the sales and earnings are so poor. Now, there are things that stabilize the S&P. We're going to show you today that the S&P's dividend yield is higher than the treasuries. So that's kind of stabilizes it. There are obviously little hot spots out there that I invest in, okay? And then we're also obsessed with having dividend growth as addition to good sales and earnings because that factor showed up as being very important recently. So, in fact, it was the best performing factor in the first quarter, just so you know. So we're obsessed with finding a silver lining, an oasis out there. I hate to tell you that everybody's misleading you, but they are. And I'll give you the last example before I get to the formal presentation. My firm's been building robo programs for a big wirehouse. And it's a long story. I don't know if they'll launch it or not. But the reason they're building want me to build a robo program is because the SEC is investigating the ETF industry for abnormally wide spreads last year. In fact, I think I could show that to you. This is Yahoo Finance. I'm going to put up DVY, which is the iShares dividend fund. Dividend ETF. It's a 5-star one. Normally you can buy and sell this pretty easy. And but you can see that last year there was a little problem in intraday in August where if you had a stop loss on this ETF or you placed a market order, you could have lost 30% in a day. So there's a myth on Wall Street as the Department of Labor comes in and mandates all these new rules that we're all going to have to put in ETFs because they're more efficient. But actually, they're not efficient when you get picked off 30% intraday. And I could have Vanguard funds up there. The same thing happened to them, ETFs. I could have the Guggenheim S&P equal. So the SEC is about to have hearings and all this. So, but what a robo thing is, it's an automated trading system. And we're trying to take our dividend grader, stock grader databases and build a quarterly rebalance program that buys the creme de la creme. And I think what the firms want to do is they want to fire all the financial advisors and replace them with robots, okay? And But the key is to build something that doesn't get picked off on Wall Street by all the specialists and things. And, but I just want to just mention something to you about robo-investing, even though I'm probably trying to build one. So if you go to Schwab and you sign up for the robo program, there is no management fee. But if you read like page 14 of the disclosure, each ETF pays $250,000 a year to be in the robo program. Well, why would you pay $250,000 a year if you're not getting a fee? And the answer is they make money from the rebalancing. A lot of these ETFs are rebalanced 90 days. A lot of them have a small cap bias. That specialist affiliate might make 3 to 4% a year under the table. So what's happening is Wall Street is trying to trick you. They're trying to grab your money, tell you they're your friend, and get paid under the table. And it's not funny. And so if I'm ever, kidnapped and hogtied in a trunk, this is because I'm exposing this. And we're here to help you. We're going to tell you the truth. We're going to give the silver lining where to invest. So let's start with the truth on earnings, and then we'll get back to our silver lining. So we are in an earnings recession. It's not the fault of our economy. It's the fault that they have negative interest rates in Europe. I've had to go to Europe 3 times this year. Europeans are pouring money in America. They are so frustrated by negative rates. And now you have negative rates in Japan. And then China is devaluing their currency. Well, Britain was also an oasis, but now they're leaving the EU, or voting to leave the EU on June 23rd. So why foreign capital pours into America is we have positive rates while the rest of the world is negative. And our government puts hideous withholding taxes on foreign investors here, but even some return is better than nothing. So the reason I've been in Europe, I'm setting up a fund over there so they can just buy the fund in Europe versus, come here and have withholding taxes. So the strong dollar has really hurt the multinationals. And so I want to be more domestic. I want to be trying to be more immune to this. Am I totally immune? Of course not. Something like a Nike, sales were up 12% last quarter. That's very impressive. But when we currency adjust Nike, their sales are only up 4.1. So 2/3 of their sales growth disappeared from currency. We have Edward Life Sciences. You may know they popped the other day. They make heart valves. They sell them all around the world. Well, unfortunately, they have a $300 million currency loss reserve. You may know that Apple lost over $5 billion in another quarter in currency losses. Okay, Apple's pretty good. Some quarters they can hedge. So, and Apple's not a growth stock anymore. I'll be back in Apple whenever its sales and earnings reemerge. It's just not a growth stock at this time. So, what's happening is this is what's hurting the S&P, and we want to find where we can go where we don't have these currency headwinds, the negative sales, the negative earnings that continue to undermine this big index. So we think domestic stocks are clearly better than multinationals. This first quarter earnings season I'm very excited about. I had a great fourth quarter earnings announcement season. I had a lot of surprises, knock on wood here. Obviously on Wednesday we had Constellation Brands and Acuity Brands. Constellation is Robert Mondavi wine. It's a Corona beer, a lot of hard liquor. Actually, my buddy's the CFO there. Not only did they beat on sales and earnings, they raised their dividend. That helped. Acuity Brands got more excited. That's a lot of LED lighting, a lot of commercial LED lighting. And what they did is they beat on sales and earnings and guided higher. So earnings work most of the time. Sometimes markets can get so distracted by things they don't work. But they are working now, so I'm very, very proud of that. And so we're anticipating having a great earnings season. And I can't tell you how important that is. CNBC bugged me the other day because they said, oh, you're doing good again. Because I guess until Wednesday, I didn't look good in their stock picking contest. So they want to know why. Of course, all I said is, well, it's because of Constellation Brands and Acuity. Their earnings came out. Anyway, the negative sales and earnings are causing the price earnings ratios of the S&P to slowly rise. And I don't think it's overvalued yet, but most of your strategists at the Morgan Stanleys of the world are forecasting a flat market this year. And I hope that I'll be up, in blue chip 18% or more. I hope in platinum I'll be up, 22, 24% or more. And why I say that, that's what my earnings are up. That's with no PE expansion. Now, often the earnings will come out and we'll have slight PE compression, but we don't pay a big premium for growth versus our peers. We'll give you some hints how we find these good stocks. It's, of course, through our Portfolio Grader Pro database. What's interesting is our new dividend grader is actually doing just as powerful as our Portfolio Grader. And we'll have a nice question and answer session for you folks today. This is a chart I need to update. It just changed. But this shows international versus domestic stocks, and you don't see much difference. I think I have a chart that's updated. Hold on. Sorry, the charts come in all the time. So I'm guilty of not always having the charts. But I have an updated one here. You don't have to memorize this. I just know where the charts are. Okay. Yeah, here we go. So here's an updated domestic versus international chart. And you can see that the domestics in red are finally breaking out over the international in blue. And this is just a very recent phenomenon. Also, the red chart is less volatile. Okay? So we do expect that the domestic stocks will have an edge. So I want to be as domestic as possible. That's very hard in blue chip growth. Okay, because even Home Depot, you think it's domestic, it's not quite domestic. Obviously, Kroger's domestic, but I want to be as domestic as possible. Ultra Salon and Fragrances is domestic. Under Armour nearby here in Baltimore is more domestic than Nike, but has a little higher P ratio. So obviously, Under Armour's rooting for Jordan Spieth today, and Nike's rooting for Rory, the tournament. But we're going to be as domestic as possible. Now, the other thing is a lot of people say, what do you mean the dollar's strong? I thought the euro's rally. The euro did rally near term. Please don't let that disturb you. Long term, the euro's not going to rally because they have negative rates. The only reason the euro rallied is the Brits are voting to leave the European Union on June 23rd. Okay, so we're going to be domestic as much as possible. So let's talk about, Alcoa came out. Alcoa is not hitting my criteria now. I have no commodity-related stocks. Now, Alcoa is obviously aluminum. Just so you know, aluminum demand is on the rise due to all the fuel economy standards and all that stuff. Does anybody here have an Audi car? Do you know where your Audi started? Davenport, Iowa. That's where the Alcoa plant is. And the Germans have carbon taxes over there, so they basically buy it from America, where we have a big coal plant running the aluminum smelter. So they put these big rolls of aluminum on, I guess, the boat, or the container ship, and it goes all the way to Ingolstadt, Germany, and they stamp out your car. So, the truth of the matter is, what's more important than Alcoa is what Constellation Brands and Acuity Brands did on Wednesday. So the S&P sales are supposed to be negative. The earnings are supposed to be more negative. We've had this huge rally in energy stocks since February 11th. February 11th was the ultimate low of the market. We will not retest those February 11th lows because on the February 11th low, we talked earlier before we started, we call that it broke the zombie apocalypse low. The zombie apocalypse low was October of 14 when the market went down because they thought we'd all be dead from Ebola in 60 days. I don't know if you remember. See, markets react, they don't think. And that's when they wanted to seal the borders and keep the doctors and nurses out of the country or put them in quarantine so we don't get Ebola, and they says we can't fly planes. Anyway, so the market freaks out in October because of Ebola. And, but we cracked through the lows, and if, the lows when they all thought we'd be dead. And then on February 11th, the 30-year Treasury yielded less than the S&P dividend yield. That's only happened 3 times in history. So we will not retest February 11th lows. But since the February 11th, we were led by financials. We were led by energy stocks. A lot of energy stocks went up over 100% or more. I think we were talking earlier, the Chesapeake Energy actually went up over 200%. That was Audrey McClellan. Remember, he drove his truck into a freeway overpass because he had got indicted. It disc drives in the back of the vehicle. And so what's happening is that we had a short covering rally. And in fact, I got a chart on that for you. And so I'm very negative on the energy stocks because I know that they don't have the earnings yet. So here's a report of what happened in the first quarter. This is from our friends at Bespoke. And what they do is they break the market into deciles. So we have the market large cap to small cap. So the top 10% of small cap to better than the bottom 10. This is the top 10% of large cap, bottom 10% of the market cap. So anyway, the one thing that stuck out is the top decile of dividend stocks did the best. But what's also interesting, the stocks that did the best in 2015 did the worst. The ones that did the best, like the Netflix and Amazons, did not lead the market, while the worst performing stocks did well. We had a short covering rally in the first quarter. It was led by the worst performing stocks in 2015, the ones with the highest short interest, the ones with the worst analyst ratings, and the smallest cap. So there was a short squeeze out there. And I don't like those factors. I'm not going to play that game. I will like this one. I understand the ones with the highest dividend is the best. I can stick with that one. So my whole thing is testing what works on Wall Street, locking in on it, and not getting faked out by all the static and noise and games that Wall Street plays. So, but going back to energy, we're very anti-energy now until they earn money. And we've had a rally here in energy prices, and it might last for a while. The inventory is tightened up this week, according to the American Petroleum Institute and the Energy Information Administration. But inventories still remain abnormally high. And I have some charts I can show you on that in a moment. But oil always goes up in the spring and then goes down in the fall. We're not going to know where oil is until September. And so what we've had in energy is we've had a seasonal surge, and we don't want to get faked out on it. And I'll show you the energy charts. Okay. So what happened is when the dollar got strong, it shoved commodity prices down because commodities are priced in dollars, and pretty much all commodities dropped. And then there were some issues with China's growth. And so not only did oil go down, all these other commodities like copper, iron ore, coal, nickel all went down. I was with a client yesterday, actually 2 days ago, that is in the stainless steel business. He builds stainless steel wire, and the steel and nickel prices are still very cheap for him. Anyway, so oil prices have collapsed, but they tend to go up in the spring. And they went up last spring, and they're going up this spring. But the question is, what happens when the fall comes? And why we're worried is here's our inventory of crude oil in America this year. You can see it's very high. Here it is last year. Here it is historically. Okay, so it might have dipped this week, but we still got an inventory problem. And so here's our inventory this year, last year, the historical range. So we're very worried about it. Now, they tell you it's all the fracking in America, which it did help. This is U.S. and Canada. You can see we got more efficient. But the untold story is Iraq. Iraq is producing a lot and just boosted again last week. Now we got Iran coming online. And then the Saudis have produced more. Russia, believe it or not, has not. So worldwide energy demand is actually growing, but the supply has been growing faster. So we have, I was in Pennsylvania last week. They have oil on rail cars not going anywhere. They put oil in tankers that aren't going anywhere. I know we're trying to export the oil. They're trying to build a bigger terminal in Louisiana. Personally, I think they just stick it all in the Strategic Petroleum Reserve because Cushing, Oklahoma is almost filled. So it's going to be fascinating to see what happens, but we're very, very worried the energy stocks are going to, sorry, I didn't mean to do that. The energy stocks are going to continue to have a problem. So we don't want to go there. And the materials sector is the same problem. Until we get industrial demand turning up, and until we get the rest of the world turning up, it's going to be tough. Just so you know where we are in America, we have been in a manufacturing recession, despite the fact a lot of us are buying the big trucks because the gas prices are cheap. But between the energy slowdown, Caterpillars, other exporters being hurt, John Deere, I can go down the list, we have a manufacturing recession. And aviation's starting to turn down. It's hard for Boeing to compete with Airbus with the dollar where it is. So, and that's why, in fact, we had that on durable goods and factory orders turning down. ISM says manufacturing is trying to turn up again. Just the first time we've seen that in months. We'll see. But for the commodity sector to do well, we really, really need the dollar to get weak, longer term, which I don't expect, and we need booming worldwide growth. So if we don't get that either of those, I think you're going to see the commodity recession continue, and you won't see the energy stocks that, in my portfolios. So these are the 50 largest stocks going in the first quarter. Only 17 of the 50 are going to have positive sales and earnings, and I own 12 of the 17. So the reason we show this is we just want you to know how narrow it is. Really slim pickings out there. And this does not help indexing. And then when I wrote this, we said it was the 5th consecutive quarter of negative sales growth, which it is, 3rd quarter of negative earnings. But there's a difference between earnings and operating earnings. FactSet says this is the 4th quarter row of negative operating earnings, 3rd quarter row of negative overall earnings. There's been a lot of buybacks. So no matter how you slice it, this isn't going to be a good quarter, okay? So the good earnings come out early. I got more earnings coming out next week. I'm going to enjoy April, but when we get into May, it'll probably get a little bumpy. And my best defense, strong offense. And if I can have a decent dividend yield under these companies with strong sales and earnings, I just won't pull back as much. The other thing is all this quantitative research we do, where we try to skew the portfolios toward the conservative stocks, is a big deal. We're monitoring risk out there for you folks. We're taking the stock's return independent of the market, divided by its volatility, and that's how we find these conservative stocks. Right now, our system says, believe it or not, that Kroger is more volatile than Facebook. Now, that may not be intuitive to us, but that's what the system says. And so any stock gets more volatile, I'm going to trim it or sell it outright. So we're going to keep you overweight in these ultra-conservative stocks that are moving in an orderly manner. How do they move in an orderly manner? 1, dividend yields. 2, good sales and earnings. 3, probably the biggest factor in the blue chip stocks, buybacks. Our average blue chip stock retires 10% of its float a year. Alaska Airlines bought back 10% of its stock last quarter. Can't do it this quarter because they got to buy Virgin America. AutoZone, O'Reilly Auto Parts, relentless buybacks. Lockheed Martin, relentless buybacks. So, you know, if the companies are buying our stocks in between the earnings season, that helps. They can't buy them right now, it's earnings season, but after earnings season, they can resume the buybacks. So we're going to try to give you a smoother ride than everybody else and just not get jerked around by all these gyrations. And we like to argue that energy stocks opened up a black hole. They're now swallowing financial stocks. And we think the rally since February 11th was the black hole burping. Okay, and then we think it'll go back down and start to engulf stocks again. So we are trying to avoid stocks that have too much exposure to the dollar. So the multinationals and energy stocks don't exist on my buy list anymore. The other problem with Wall Street is when you read anything online, I'll say, don't you want a 4% dividend yield? Don't you want to buy this ETF? We all want a 4% dividend yield. But when you buy that ETF, they don't tell you that dividend yield could be coming from Caterpillar, Exxon, Chevron, companies that might have to cut the dividends. So let's see who's cut the dividend. Kinder Morgan, Endarco, Marathon Oil, ConocoPhillips. Exxon and Chevron have had to stop their stock buybacks to preserve cash flow. Exxon's on credit watch by Moody's. I don't think Exxon or Chevron will cut their dividends in April or July, but they might in October if oil turns down. I hope I'm wrong. We don't want to see this happen, but it might be happening because Exxon's on credit watch with Moody's. Exxon gave us 75% of their cash flow in dividends last year. This year it's 115%. And you just can't sustain that forever. So we got to be really careful. We also have to be careful about what the analysts are doing. The analysts were revising Constellation brands and Acuity brands higher before they surprised on Wednesday. I want all my stocks to have positive analyst earnings revisions, and on large they do. What happens though is if the analysts start to cut, that often precedes an earnings disappointment. We want positive analyst revisions. The analysts are shockingly negative this quarter. Now, some people think, well, they're so negative we can only surprise. Well, that's nice. But we have positive analyst earnings revisions, and negatives are to be avoided. So what we've done is we've taken our quantitative databases and tried to empower you with Portfolio Grader. And the A-rated stocks are clearly the best. They're strong buys. They only last 4 to 5 months. The Bs are buys. And I'm buying you As and Bs to get you long-term gains because I'm trying to move you to that 23.8% tax bracket, which is better than 43.4 for short-term gains. I know if Hillary gets elected, she wants to make us wait 6 years for long-term gains. Let's not worry about that now. We'll deal with that later, okay? She's got Congress to deal with, and Bill actually cut capital gains, so I'm not sure why she want to raise it, but maybe they haven't talked yet, okay? I want to take you to Portfolio Grader and just give you a little review of how this works and what a powerful tool we have for you. So let's take you to Portfolio Grader. And we just go to Navellier. Oh, actually, there's a button here. And so let's just put in AYI Acuity Brands, which is one of our stocks. Okay, so Acuity, you can see, was a B for 3 months, and the last 9 months it's been an A stock. These are all its fundamental factors. It happens to get a B in sales, a B in operating margin expansion, a B in earnings stability, a C in earnings momentum, a B in surprises, an A in analyst revisions, a C in cash flow, an A in return equity. So it gets an overall B, which it's very hard to get an A fundamentally, but it gets a quantitative A and a fundamental B. So when you use Portfolio Grader, you can look in and dig in all these details and see all the good stuff. And let's put in Constellation Brands, which just popped. Looks almost identical. That's kind of scary. A little less volatile stock, but it also gets a fundamental B. We have some stocks they're going to announce on the 26th. One is Public Storage. Public Storage, I got a lot of grief on this when I was on CNBC in January because I picked that in the CNBC contest, and Joe Kernan, thought I was a weenie because, he wanted things to make 300% in. And in January, the market was going down. It got up in the wrong side of bed early in the year. And I said, Joe, if we go into recession, this will do well because people have to store their stuff. But public storage is really a dividend growth story. They love to raise their dividends. And it has positive analysis revisions, and it's actually one of the safest stocks we have. And it's an example of a recession-resistant company, a domestic company, and it's also an example of, a stock that's hitting on all cylinders. It's got the dividend growth, it's got sales and earnings growth, and it will do better if we go into recession. And there's another stock that's going to announce on the 26th, Total System Services. This one missed by a penny last quarter, operating, but it wasn't a big deal. It's still an A-graded stock, but you can see that penny miss really hurt the stock. But we do think it'll come back and rectify. And so we'll find out. This is a very, very powerful tool, so take advantage of Portfolio Grader. Of course, one of the nice things here is the way Portfolio Grader works is we can just pull up the Platinum Growth Club right here. And we have all the platinum stocks online. So, and of course you can sort the stocks in order of attractiveness. So now I have all the A's. And of course platinum growth is supposed to be predominantly A's. I've got some B's. The only C I have is Centene because I'm waiting for the earnings to come out. I think it's April 28th. Their earnings are supposed to be pretty darn good. I had Yahoo up here the other day. Where was Yahoo? This is a trick. Yahoo isn't as updated as my databases, but it's close. So Centene's supposed to have 41.7% sales growth. It's supposed to have 42.3% earnings growth. Okay. It has surprised recent quarters, 10.5% surprised last quarter. So I want to hold this one more time in earnings season. And then if it doesn't do well, it won't be in platinum growth after that. Okay? Or I might sell in the strength depending on the risk. I'm always monitoring the risk. But there are windows to sell stocks in. A couple other things about our stock picking, things I want to mention. We only buy stocks that trade at reasonable forecasted price-earnings ratios. We love stocks that are aggressively buying their stock back. It's very obvious in blue chip. We want expanding operating margins by and large because when the operating margins expand, the earnings grow faster than sales. Our stocks have a high return equity. High return equity stocks tend to buy their stock back. We like strong cash flows, and we love rising dividends when possible. So when somebody like Constellation Brand raises dividends, it's a big deal. Our average stock in blue chip is going to be gone in 14 years, just on buybacks. I think we have a good retirement plan. We buy these stocks and they're gone, okay? They just buy them out, but we shall see. It's time for questions, and we'd love hard questions because it makes the session more fun. So you give us a lot of money for Platinum Club. We appreciate it. You spend a lot of money coming here. We just want to answer everything and anything for you. And of course, my sessions will be in this room the whole time. So, yes?
How do you weigh out dividend grader where you might have a stock that is an A, but in the other portfolio grader, it might be a B? Like, how do you take away that?
Well, ideally, we want A's and B's. If it's a D in stock grader and A in dividend grader, it's just a dividend stock. It's not going to end up in blue chip growth or Platinum Club. But we really want to find the creme de la creme in both. And I guess the best way to give you this answer is to show you how they perform. So this is something we've been building here for a while. So that is stock grader last 18 years. By the way, we took 3% off a year, assuming transaction costs. But that's how the A's, B's, C, D's, and F's compound. Here's in the last 10 years, and you can see it had a little volatility here in 2008, but it's recovered and done well. Here's the 18-year performance of dividend grader, still very impressive. I'm sorry to tell you that there's not that many dividend A's, and they don't last as long as the A's and stock grader, but boy, when we find them, they're great. And then here's dividend grader in the last 10 years. Now this looks a little better because you can see in 2008 these didn't get hit as hard, okay? And then here's dividend grader, stock grader and dividend A's last 18 years. Here's the A stock grader and the A dividend grader, okay? So two very good models. Last 10 years, here's dividend grader and stock grader. Dividend grader is actually beating stock grader in the last 10 years. So a lot of people think I'm a weenie or I've gone nuts that, Louis used to be a growth manager and, I could double my money with you and now you're just turned into this dividend weenie. Well, you know what? The dividend stocks are doing a little better. So that's where the performance is. And if I want to lower risk, that's how I do it. So it's not that dividends replacing stock grader, dividends invading our growth stock portfolios. And not only is that invading our growth stock portfolios, so are the buybacks. And so are what we call lower P ratios. Blue chips trades at 16.4 times forecasted earnings. That's a very low PE. I was incredibly anti-Netflix last year. That's number one performing in the S&P. I was incredibly anti-Amazon. That's number two performing in the S&P. I left a fund company over this fight because we had some young 40-year-old institutional sales guy thought I was nuts for looking at valuations. Okay? Of course, he wasn't trained in finance, and he was actually a college cheerleader. He was very good. But, he was so busy cheering Netflix and Amazon, he didn't know what fundamentals were. And then they got hit this year with analyst downgrades, and just been a mess ever since. So again, I want to use every tool I can get. So what we're trying to do is increasingly blend these together. And that's also what we're doing in the new dividend service. There are very few stocks that get a double A in both dividend and stock grader, and every single one is bought. A lot of sin stocks in the double A's, though, by the way. Hope you like cigarettes and booze, okay? Okay. Yes. Yes. Yeah, you had your hand up earlier, I thought, yeah.
I had a question which I actually sent in at one time. May not have sent it to the right place and don't know if it was ever answered.
Everybody that's anybody is here, so we'll get everything answered.
And I may not remember the stock symbol properly, and I'm no good with
That's okay.
names, but SWKS.
That's Skyworks Solutions, yes.
Yeah. And you have recently recommended selling it.
Mm-hmm.
I sent my question in back when it was sky high.
Mm-hmm.
Because I wondered if it had become a disproportionate section of my portfolio and if I shouldn't sell some then. And I never got a response, so I didn't. And I'm wondering whether this is something you ever do when something goes that high and just...
Sure. Well, I had 3 chip companies, NXPI, which I've sold, Skyworks Solutions, which we, I can tell you under management was sold, and AVGO we haven't sold. And I guess the main reason is the sales were drying up for Skyworks Solution, although they're going to be up 1.4, and the earnings are going to be up 125 versus 115. So on Tuesday, April 26th, we're going to find out. We see we have positive analyst revisions, but it only has 1.8% sales growth, 8.7% earnings growth. So, frankly, let's see, and it has a pretty good earnings surprise history, not a lot, but it does have a positive analyst rating. This stock just got too volatile, and I did not react till it got volatile. And there it is in the past year. So I suspect it'll have a good earnings season, and then it's time to sell the stock. I'll be honest with you. So let's put in Portfolio Grader and see where she ranks now. And I just don't react till they get volatile. And it just, this one got a little bit too hot to handle for me. Hold on here. SWKS. Now you can see it was an A, then B, and now it's a C. So technically it's a hold in the system, but I would probably sell it after the earnings. So this is one reason it'd be good to have, go online and click on Platinum Growth, Energy Services, and all this will come up. And when in doubt, some good stocks buy better stocks. The hardest thing that we do is try and keep you in the conservative stocks. This stock was actually not that risky a while ago. Then it got more risky and it got booted from my system. So I apologize if you still have it, but you'll have a good earnings report next on Tuesday the 26th. I would sell that.
Okay, but that still misses my point. Do you ever, when something skyrockets, and when it becomes a much larger part of the portfolio, do you ever trim some?
I do for a variety of reasons. One is it'll get overweighted. Two, it'll get riskier. Risk to me isn't the angle of ascent, it's dispersion. So if they go up in a smooth, steady manner, we don't think they're risky. So let me show you how you trim. So, one of the most powerful tools we have for you on Portfolio Grader, or the Platinum Club, and the Platinum is my favorite portfolio, just so you know. That's not it. Hold on here. Navellier Growth, Platinum Growth, Allocation tool. Here we go. So the way this works is we ask you a few questions, and depending on how you answer them, we tell you how to invest. If you're conservative, 70% blue chip, fractions the other. If you're like me, moderately aggressive, half your money in blue chips, a little bit more in others. If you behave like Jim Cramer, this is your mix. Okay. So if we had Skyworks Solution in here, which we don't anymore, you basically key in how much money you want to invest, okay, and follow the mix. So let's just say right now you have 200 shares of Darden and you're a conservative investor. Well, we tell you now to have 135, so sell 65. This is the best tool we came up with to trim your portfolio from time to time. So what's happened is, now when you trim, you got to look at where's your money. If it's in a pension, go ahead and trim. If it's taxable, maybe wait till it's a long-term gain. So let's just say this is Skyworks Solution. I tell you, you have 200 shares of today, 135, then sell 65. So this is why we have this. Trimming what we call the risk, the profit portfolio is how we do this. Now at my management company, we have these things called optimization models that tell us what weight each stock should be. How those things are working is stocks are squiggly lines, and it's trying to combine the squiggly lines to make a smooth line, and that's how the weights come. And as things get riskier, their weight drops, and eventually they get booted. And we're doing the same thing here, and we've just try to make it extra easy. So please try to use this. Everyone in Platinum, please just key in how much money you want to invest. Hit the calculate button and retest it. So let me just try it here, see if I can use my own system. Okay, so I'm going to put in $500,000. We'll hit the calculate button, and the weight should change. Yep, they did. Now you're supposed to have 270 shares of Darden, okay? That's your ticket. And if you don't like any of this computer stuff, you can always call me. good tool, and it's, trimming risk is a big deal. Yes?
Louis, when you mention volatility, are you describing it as price movement, slowly price movement, or how would you?
That's an outstanding question. I have to give you a complicated answer. So volatility to me is something called standard deviation, so much something wiggles, okay? So that's, and what our top secret quantitative formula is alpha over standard deviation. It's a long story, but I do my alphas better than everybody else because people do alphas against the wrong benchmarks. It's a long story, but I match up, you know, if I'm grading Chihuahua, I'm going to put it in the little dog category. If I'm grading a Great Dane, I'm going to put it in the big dog category. So a lot of people that do all this math stuff do it wrong, but we do it right.
So,
And then, so that's the first thing is to do the math right. And then, but inside that standard deviation calculation, there's something called beta, which is market risk. And there's something called unsystematic risk, which is the risk we can't diversify away. Okay? So beta times the benchmark plus unsystematic risk equals total standard deviation. That unsystematic risk is the big deal nowadays. A blue chip stock has about 0.58% unsystematic risk when I go buy and sell. A mid cap stock has about 1.8%. Small cap stock is unfortunately about 6%. ETFs last August after the August 24th were running about 458. Today they're running about 357. So that's what we call the static in the market, the risk we can't diversify away. And we don't like to have this random thing screwing up our portfolio. So we want to get it as low as possible. And that's what comes back to when we do all this fundamental work, all this skew it to the low risk stocks, having the good sales, earnings, the margin expansion, the lower P ratios, and now we have to have dividend growth. We have dividend growth not because I'm a dividend nut, okay? We have dividend growth because it's an important factor and it's invading all the portfolios. And no one should be offended by dividends. It's nice they're giving us money, and they're also tax advantage. So I think, and I think the other reason dividends become important is when they decimalized our markets, they made it more volatile. They made it more vulnerable to short sellers and shenanigans. And what I'm trying to do is I just want to ignore all that. I just want to have a smoother ride, and I want us to compound our money in a smooth, steady manner so we don't have to worry about all these distractions. Yeah.
a frequent criticism about stock buybacks is that the company has run out of ideas how to better investments. And the example often given is IBM. Your thoughts?
Sure. Well, I can dispel that myth. Finance 101 at any business school, Georgetown over here, American University, anyone, anybody nearby, is should I finance my business with debt or equity? So the case that they use in finance is if you trade at 50 times earnings, and you've got a volatile business like software or something, sell stock. However, if you trade at 6 times earnings, been around
philosophy, sidestepping the market when things are not doing well and some of the, and sell all the part of the stock to save the money for a low buy.
Sure. Sure, I'm gonna repeat his question so everybody can hear it. He wants to know, are there times to step out of the market and come back in? In other words, be more tactical, be more nimble and quick. One of the things that is important when you do tactical investing is to look at your taxes, okay? So we can always hop out of the market, but you'll be paying 43.4% taxes versus 23.8. So if you have pension money, that might be good. The other problem is when you hop out of the market actually yields more than the bank, okay? So then you gotta say, do I wanna lose that dividend income and earn next to nothing? Even though I've just said that, at my management company, we do tactical. And I'll talk to you about tactical stock versus tactical being fully invested. So I'm known as a good risk-adjusted manager. Being in the market isn't a problem for me. We've done that since '98 in real money, billions of dollars. My thing is, I beat it with less risk. My beta's lower, my standard deviation's lower, my max drawdown is lower. I've got these charts that show me versus the world. Every other buddy's a dot. And I'm proud that I'm the safety stock. We take that system and then we put a tactical overlay on it. We have something called a go ratio, which is essentially an alpha momentum ratio, where we just basically load up on more A's. And it's a top 20 portfolio and we will build cash. Okay? That particular portfolio has 60% of the upside, 40% of the downside. So you will have a smoother ride. So we do that. However, you have full taxes. We are starting a fund on that because when the fund grows, it'll be more tax efficient. So long story, I'll explain that later. But we do that. And I think you should do it based on what we call your pain threshold or risk tolerance. Okay? You can do this on our own. I meet a lot of subscribers who do better than me because they just buy A's. And I'm buying A's and B's to get long-term gains. So already the way we rank stock, you can beat me. updated every week.